Disclaimer.
The morning of February 2nd started as the crash of the century, but right now, something is happening that no textbook can explain. Gold has just staged a vertical $350 surge, and silver has jumped $12 from its intraday lows. Is this just a dead cat bounce designed to trap you before the next leg down, or have we just witnessed the birth of the ultimate market floor? While the paper charts on the CME are screaming panic, the physical world is telling a completely different story. Today, I'm bringing you the proof they can't ignore. From 95% premiums in China to empty vaults in Singapore. Let's look behind the curtain at what's really happening on the exchanges. I told you this was coming. When Bitcoin broke below $82,000, I warned that silver would hit 71. Last Friday, that's exactly where it crashed, $71 per ounce, the worst single-day collapse in over 4 decades. But here's where this story gets strange. Within hours, silver exploded 17% higher to $83 overnight. Gold recovered $350 from its $4,440 low. And right now, as New York prepares to open in just a few hours, we're about to find out if this bounce is real or if we're walking into a trap before another devastating leg down. Here's the question nobody's asking. What happens when paper markets crash 28% in one day, but physical demand doesn't just hold, it actually increases? You get lines forming outside dealers in Singapore. You get sold-out inventory across Australia. You watch China and Hong Kong buyers empty the shelves while their online platforms like JD, Com show silver trading at a 95% premium, $163 when Comex paper says 83. That's not a normal market correction. That's a war between paper manipulation and physical reality. And the disconnect is now so extreme that our traditional price discovery system might be breaking in real time. The setup was perfect for disaster. Our community saw it forming for weeks, Bitcoin topping out, margin requirements climbing, leverage stacking up across every corner of the market. When Kevin Warsh got nominated as the next Federal Reserve chair pick, markets read him as the ultimate hawk. The dollar spiked. And suddenly all that leverage in precious metals started unwinding fast. Silver, which had been the star performer climbing toward $100 territory, became the epicenter of forced liquidation. 28% gone in a single session. That matched the panic of March 1980 when the Hunt brothers' silver empire collapsed. But here's what should grab our attention. While Western paper contracts were getting annihilated, physical silver went into something called backwardation. For those new to this term, backwardation means near-term contracts trade higher than future delivery contracts. It signals that people want metal now, not later. Silver's backwardation hit $2.88, the deepest level since that same Hunt brothers crisis. When the market structure itself is screaming shortage at the exact moment prices are crashing, someone is lying. Either the paper price is wrong or the physical shortage narrative is wrong. They can't both be true. Let me put this in perspective with something that happened to real people over this past weekend. In Singapore, dealers reported lines of buyers waiting to purchase physical silver bars and coins, even as the spot price was cratering. Australia saw similar scenes, people rushing to lock in metal at these lower levels. Meanwhile, in China and Hong Kong, online retailers simply sold out. The premium between what people were willing to pay for actual metal versus what the Comex paper contract said it was worth exploded to levels we rarely see outside of true crisis moments. According to data from Chinese e-commerce platforms, that premium hit 95%. Think about what that means. If you wanted real silver in your hands in China, you paid nearly double what the official price said it should cost. The community response has been fascinating to watch. We're split right now, and that division isn't weakness. It's actually a sign of prepared, independent thinkers executing their own carefully considered plans. Some members looked at $71 and saw capitulation, the moment when maximum fear creates maximum opportunity. They started buying aggressively, believing we just witnessed the bottom and everything from here moves higher. Others are preparing for a retest of that 71 level, or even lower, keeping powder dry for another potential wave down. Both groups have valid reasoning. Both are watching the same data streams. The difference is interpretation and personal risk tolerance. But there's one thing both camps agree on. What happens when New York opens in the next 6 hours will determine everything. The CME, that's the Chicago Mercantile Exchange where these futures contracts trade, just hiked margin requirements again, effective at the Monday close. This is critical because higher margins mean traders need more cash to hold the same positions. When you're already underwater and suddenly need to post more collateral, what happens? Forced selling? More liquidation, additional downward pressure on price, regardless of underlying fundamentals. The timing of this margin hike, coming right as we're testing whether this bounce from 71 to 83 can hold, is either terrible coincidence or strategic pressure applied at the perfect moment to trigger another flush. Have you noticed that every time precious metals start to break out, the rules seem to change? Margin requirements go up, delivery terms get modified, the system finds ways to make it harder and more expensive to maintain bullish positions. Now, I'm not here to push conspiracy theories. These are documented exchange policies, publicly announced changes, but the pattern is undeniable, and it raises an uncomfortable question. If the paper price can be pushed around through margin mechanics, while physical demand remains robust, which price is actually real? Here's where the physical evidence becomes impossible to ignore. Silver lease rates, that's what it costs to borrow silver for short periods, spiked to 39% back in October. Normal lease rates run under 1%. Even now, after the price crash, 1-month lease rates are still elevated at 11%, according to London Bullion Market Association data. What does that tell us? Metal is not freely available to borrow. When borrowing costs stay high, even as prices fall, the physical shortage story gains credibility over the paper crash narrative. Let's talk about what didn't happen during this crash, because sometimes what doesn't break is more revealing than what does. Shanghai Futures Exchange vaults held stable. Even as the price imploded, Chinese commercial inventories didn't flood the market with distressed selling. The Shanghai premium, the amount Chinese buyers pay over the international spot price, was running at 43% over the weekend. As of right now, it's compressed to 22%, which still means Shanghai silver trades at roughly 1,142 yuan, while Comex says $83. That premium is holding because Chinese buyers don't care what paper contracts in New York say metal is worth. They care about securing physical supply, and they're willing to pay significantly more to get it. Think about this scenario for a moment. You're watching your investment drop 28% in a single day. That's brutal. That's portfolio destroying if you're over-leveraged or new to volatility. But what if you had been preparing for exactly this moment? What if you understood that massive price dislocations create opportunities that don't exist during calm, orderly markets? The people standing in line in Singapore weren't panicking. The buyers clearing out inventory in Australia weren't confused. They recognized a violent paper market shakeout as a chance to acquire physical metal at temporarily disconnected prices. The Comex registered silver vaults, those are the bars available for immediate delivery, have been bleeding inventory for months. Back in September, they held over 400 million ounces. Current levels are substantially lower, while December delivery volumes just hit 2.5 times any previous December on record, according to CME Group data. Stop and process that for a second. In the middle of a massive price crash, delivery demand is at all-time highs. People are pulling metal out of the system at record pace, even as the price signal says nobody wants it. That's not normal market behavior. That's a disconnect between paper trading and physical settlement that suggests the paper price may have lost its ability to accurately reflect real-world supply and demand. New York opening in a few hours will be the moment of truth. If selling continues, if that $71 level gets tested again or breaks lower, we'll know the paper market still has control and more pain is coming. If the bounce from 71 to 83 holds firm, if buyers step in aggressively as New York traders arrive at their desks, we'll know capitulation happened and the worst is behind us. Either way, the next session isn't just another trading day. It's the battle line between paper manipulation and physical reality, and whichever side wins this round will set the tone for weeks or even months ahead. Are you ready to watch what happens next? Because ready or not, the decision is coming. Let me show you something that will change how you view this entire market. Right now, at this very moment, Shanghai silver is trading at a 22% premium over Comex. That means Chinese buyers are paying 1,142 yuan for metal that the New York paper contract says should cost $83. Over the weekend, that premium exploded to 43%. Think about what that reveals. Even after compressing by half, Chinese buyers are still willing to pay substantially more than the Western paper price. This isn't speculation. This is real money changing hands in one of the world's largest physical markets, and it's telling us the paper price has lost credibility in the eyes of actual metal buyers. Here's where it gets even more interesting. The Shanghai Futures Exchange vaults, those massive warehouses holding commercial silver inventory in China, remained stable throughout this entire crash. While Comex paper contracts were getting obliterated, while margin calls were forcing liquidation across Western exchanges, the physical metal sitting in Chinese vaults didn't move. There was no panic selling, no flood of distressed inventory hitting the market. According to Shanghai Futures Exchange data, those vault levels held firm even as the price signal said everyone should be running for the exits. When physical holders refuse to sell at crashed prices, what does that tell you about whether they believe those prices are real? You want proof that something unprecedented is happening in the physical market? Look at silver backwardation. We covered this briefly in the first part, but let me give you the full picture of why this matters so much. Silver is currently in backwardation at $2.88, the deepest level since the 1980s Hunt Brothers crisis. For context, normal markets trade in contango, meaning future delivery costs more than immediate delivery because of storage, insurance, and financing costs. When that flips into backwardation, when people are willing to pay more for metal today than for delivery months from now, you're witnessing a shortage signal that overrides normal market structure. The metal is worth more in your hand right now than as a promise for future delivery, and that premium is wider than anything we've seen in over 4 decades. But backwardation is just one piece of the shortage puzzle. Let's talk about lease rates, the cost to borrow physical silver for short periods. Back in October, according to London Bullion Market Association data, 1-month silver lease rates spiked to 39%. To put that in perspective, normal lease rates run under 1%. You're talking about a 40-fold increase in the cost to borrow metal. Even now, after this massive price crash that supposedly relieved all shortage pressures, those lease rates are still elevated at 11%. What does that tell us? Physical silver remains difficult to source and expensive to borrow. When lease rates stay elevated even as prices collapse, the paper crash story and the physical shortage story are giving us completely opposite signals about what's really happening in the market. Now let me walk you through what's been happening at the Comex vaults, because this is where the paper-physical disconnect becomes impossible to ignore. Back in September, Comex registered silver vaults. Those are the bars available for immediate delivery against futures contracts, held over 400 million ounces. That's the buffer that allows paper contracts to function smoothly. The inventory that backs the promise that if you stand for delivery, metal will actually be there. But over the past several months, according to CME Group reports, those vault levels have been bleeding inventory steadily. Meanwhile, December delivery volumes just hit 2.5 times any previous December on record. Stop and process what that means. In the middle of a brutal price crash, delivery demand is at all-time highs. People are pulling physical metal out of the Comex system at record pace, even as the price signal says nobody wants it. Have you ever watched someone drain a bathtub while claiming the tub is overflowing? That's what's happening here. The paper price is screaming surplus, 28% crash in one day. Margin calls, forcing liquidation. Bearish sentiment everywhere you look. But the physical flows are screaming shortage. Record deliveries, declining vault inventory, elevated lease rates, persistent backwardation. Both can't be true. Either the paper market is manipulating price downward despite genuine physical tightness, or the physical shortage narrative is exaggerated, and those deliveries represent normal market function. The evidence strongly suggests it's the former, and that has profound implications for where prices go once the paper manipulation loses its grip. Let's expand our view beyond just Shanghai and Comex. The physical paper disconnect isn't limited to China and the United States, it's global. India's IBGA spot price, that's the India Bullion and Jewelers Association benchmark, hit 178,100 rupees, while MCX futures peaked at 162,700 rupees. Think about that for a second. Even in the futures market, which is supposed to trade at similar levels to international benchmarks, Indian silver showed a premium during the crash. Physical buyers in India weren't deterred by falling Comex prices. They kept buying, kept bidding up local markets, kept demonstrating that demand in the real world doesn't follow the same script as paper contract liquidation. Dubai is showing a 40% physical premium right now, according to precious metals dealers operating in the UAE. That's not a brief spike. That's a sustained disconnect between what international paper contracts say silver is worth and what buyers in the Middle East are actually willing to pay to secure physical metal. London lease rates, sourced from the London Bullion Market Association, continue to prove that metal is not freely available for borrowing. When you can't easily borrow silver to meet delivery obligations or to hedge positions, that constraint feeds back into the physical shortage story and puts upward pressure on anyone trying to acquire actual bars rather than just paper promises. And here's a factor that's flying under most people's radar. China's January 1st export controls on silver just kicked in. The Chinese government implemented new restrictions on silver exports as part of broader strategic material controls. What happens when one of the world's largest silver producers makes it harder to export metal out of the country? Supply available to Western markets tightens. Premiums in China rise as domestic buyers compete for metal that can't easily leave the country. The global physical market fragments even further, and Western paper prices become increasingly disconnected from what is actually happening in physical trading across Asia and the Middle East. You might be wondering, if the physical market is so tight, why did the price crash so hard? That's the right question, and the answer lies in understanding the difference between paper leverage and physical metal. The Kevin Warsh nomination as the next Federal Reserve chair pick triggered a massive dollar spike. Markets interpreted Warsh as an inflation hawk who would keep rates higher for longer, which traditionally strengthens the dollar. When the dollar surges, dollar-denominated commodities like gold and silver face selling pressure in paper markets. Leveraged traders who were long precious metals suddenly faced losses on their positions, and when losses hit a certain threshold, Margin calls force automatic liquidation regardless of the trader's view on fundamentals. That cascade of forced selling, amplified by algorithms and high-frequency trading systems, created the 28% single-day collapse we witnessed. But here's what should give you pause about that explanation. Physical buyers didn't interpret the dollar strength and Warsh nomination the same way paper traders did. While leveraged speculators were being forced out of positions, physical buyers in Singapore lined up outside dealers. Australian buyers cleared out inventory. Chinese platforms sold out completely. These aren't panicked sellers. These are informed buyers who recognize that a paper market dislocation created a temporary opportunity to acquire metal at prices disconnected from underlying supply-demand fundamentals. The physical buyers see dollar strength and potential rate hikes as confirming the very thesis that drove them to precious metals in the first place: growing debt burdens, fiscal instability, and the need for hard assets outside the banking system. Let me paint you a picture of what this fragmentation looks like on the ground. You're a silver buyer in China. You check Comex prices and see $83. You think, great, I'll buy at that level. But when you try to actually acquire physical silver through local dealers or online platforms like JD.com, the price you're quoted is $163, a 95% premium over the Western paper price. You're not buying a paper contract. You're buying actual bars that get delivered to your door. And at that moment, you realize the Comex price is essentially fictional for your purposes. It has no bearing on what you actually have to pay to secure metal. That's the fragmentation we're talking about. Western paper prices no longer clear global physical demand. They clear leveraged speculator positioning, while physical markets operate in a parallel universe with their own pricing dynamics. The evidence is overwhelming when you stack it all together. Shanghai premium holding firm despite price crash. SHFE vaults stable when they should be flooding the market with distressed selling. Silver backwardation at 4-decade extremes. Lease rates elevated for months. Comex vaults draining at record delivery pace. India showing premiums even in futures. Dubai at 40% over spot. London proving metal unavailable for borrowing. China export controls tightening supply. Every single one of these data points tells the same story. The physical market is not breaking. Only paper is breaking. And when paper prices diverge this far from physical reality, something has to give. Either paper reasserts control and physical premiums collapse, or physical takes over price discovery and paper contracts become increasingly irrelevant to real-world transactions. Right now, we're watching that battle unfold in real time. The next few hours as New York opens will show us which side is winning. Let me lay out exactly what we're facing here, because the path forward splits into two very different scenarios, and you need to understand both before New York traders hit their desks. This isn't about predicting the future. It's about preparing for multiple possible outcomes, so you're not caught flat-footed regardless of which way this breaks. First, let's walk through the bearish scenario, and I need you to take this seriously even if you're bullish on metals long term. If New York opens and selling continues, if that $71 level gets tested again or breaks lower, we're looking at a potential cascade that could take silver substantially lower before any real bottom forms. The CME margin hike that just went into effect means traders holding positions need more cash collateral right now. When you're already underwater and suddenly face higher margin requirements, you have two choices: post more cash or liquidate. Most choose liquidation. That creates additional selling pressure that has nothing to do with fundamentals and everything to do with forced deleveraging. Here's where it could get worse. Bitcoin is currently hovering around $74,000 to $76,000. If Bitcoin breaks decisively below $74,500, that signals broader risk-off sentiment spreading across all speculative assets. When risk appetite collapses, everything correlated to risk trades lower together: crypto, tech stocks, commodities, precious metals. We saw this exact pattern in March 2020 when COVID lockdowns hit. Gold and silver initially sold off hard alongside equities because leveraged players needed to raise cash wherever they could. The fact that metals are supposed to be safe havens didn't matter in that moment. What mattered was meeting margin calls and covering losses, and that meant selling whatever you could sell, regardless of the asset's long-term value proposition. Now, add in this critical factor. Our country has $9.6 trillion in government debt maturing within the next 12 months, according to U.S. Treasury data. That's not total debt. That's specifically the debt that needs to be rolled over or refinanced in the near term. When you're facing that kind of refinancing pressure in an environment where the Federal Reserve might keep rates elevated, stress builds in the financial system. Banks holding long-dated bonds face mark-to-market losses. Credit markets tighten. Liquidity becomes more precious. And when systemic stress rises, deleveraging accelerates. Everything gets sold to raise cash, and safe havens like gold and silver often get dragged down initially before they recover. The historical pattern is clear if you know where to look. During the 2008 financial crisis, gold dropped from over $1,000 to below $700 between March and October of that year, even though the crisis was fundamentally about financial system instability that should have driven safe haven demand. Why did gold fall? Forced deleveraging, margin calls, hedge funds liquidating positions to cover losses elsewhere in their portfolios. The same thing happened in March 2020. Gold fell from over $1,700 to below $1,500 in just a few weeks, as COVID panic triggered indiscriminate selling. In both cases, metals stopped falling before equities did, and then recovered sharply while stocks continued struggling. But that initial drawdown was brutal for anyone over-leveraged or unprepared for the volatility. So if this bearish scenario plays out, here's what you should expect. Silver retests 71 or potentially goes lower to find the true capitulation level, where all weak hands are finally shaken out. Gold could pull back toward 4,200 or even 4,100 if the selling intensifies. The physical paper disconnect might actually widen further as paper crashes, while physical buyers continue absorbing supply at these levels. And critically, the real bottom might not form until metals stop falling but equities keep dropping. That divergence, when precious metals stabilize while stocks continue declining, is often the signal that the worst is over for metals and the next leg higher is beginning. But getting to that point could require more pain in the near term. Now let's flip the coin and examine the bullish scenario, because the case for this bounce being real rather than a dead cat trap is also compelling. The move from $71 to $83 happened fast and with conviction. That $12 surge wasn't tentative nibbling by bottom fishers. It was aggressive buying that overwhelmed the selling pressure. If New York confirms that buying interest in the $83 level holds as support, we may have just witnessed maximum bearish sentiment and the formation of a major bottom that won't be taken out. Think about the setup that preceded this crash. Sharp, violent price drops are specifically designed to shake out weak hands and over-leveraged speculators. The 28% single-day decline accomplished that goal spectacularly. Everyone who was long on margin and couldn't meet the call got liquidated. Everyone who panicked and sold at the bottom is now gone. What remains are strong hands, physical buyers lining up in Singapore, Chinese buyers clearing out inventory, institutional players who recognize that nothing about the fundamental bull case for precious metals has actually changed. Our national debt keeps growing, deficits remain structural, geopolitical tensions haven't resolved. The reasons people were buying metals before the crash are still fully intact. And here's a ratio that should make you sit up and pay attention. The gold-silver ratio just hit 57 to 1. That means it takes 57 ounces of silver to buy 1 ounce of gold. Historically, that ratio has averaged closer to 15 to 1 over centuries of data. Even using more recent history, the ratio typically runs between 50 and 70, and we just tested the low end of that range. What this tells us is that silver remains severely undervalued relative to gold. If gold holds its recovery and moves higher from here, silver should outperform on a percentage basis as that ratio compresses. The historical pattern is reliable. When precious metals enter bull markets, silver amplifies gold's gains on the upside because of its smaller market size and higher volatility. Here's something that caught my attention. Bank of America just raised their 2026 silver price target to $65. This is significant because Bank of America is not some fringe newsletter or gold bug blog. It's a major institutional bank with clients managing billions of dollars. For them to issue a bullish call on silver in the immediate aftermath of a 28% crash takes conviction. According to their analysis, the fundamental supply-demand dynamics support substantially higher prices over the next year. When mainstream institutions start getting bullish on metals after a major shakeout, that's often a sign that smart money is positioning for the next leg up while retail sentiment is still bearish. And let's return to the physical evidence one more time, because this is what gives the bullish case its foundation. When paper markets break, physical takes over pricing. We're seeing that process potentially beginning right now. The Qs in Singapore, the 95% premiums on JD, Com, the backwardation, the sold-out dealers across Australia and Hong Kong, none of that is fake. Those are real transactions at real prices, demonstrating real demand. If the physical market refuses to validate these crashed paper prices, if premiums stay elevated and buyers keep absorbing supply aggressively, then eventually the paper price has to converge toward physical reality rather than the other way around. That convergence could drive prices substantially higher as the disconnect resolves. So which scenario plays out? That's what the next several hours will tell us. And here are the 5 specific things you need to watch to understand which path we're on. First, does the $71 to $83 bounce hold or fail when New York opens? If we see aggressive selling right out of the gate and silver breaks back below $80 quickly, the bearish scenario is in play and we could retest or break the lows. If buying continues and 83 holds as support, the bullish case gains credibility and this bounce is likely real. Second, watch Bitcoin closely. Does it stabilize in that $74,000 to $76,000 range, or does it break decisively lower? Bitcoin has become a leading indicator for risk appetite across all speculative assets. If Bitcoin holds and starts recovering, that takes pressure off precious metals. If Bitcoin breaks down hard, expect contagion to spread across the entire risk asset complex, including metals. Third, watch equity markets. Do stocks stabilize or gap down hard at the open, dragging metals lower with them? We need to see whether this is just a metals-specific situation or part of broader market stress that forces indiscriminate selling across asset classes. If equities stabilize while metals bounce, that's bullish for metals. If everything sells off together, we're in the deleveraging scenario and more pain is coming. Fourth, monitor the Shanghai premium throughout the day. Is it holding at that 22% level, or is it compressing back toward 10%? If the premium compresses significantly, that suggests physical demand is weakening and paper prices are starting to reassert control. If the premium expands back toward 30 to 40% levels we saw over the weekend, that's a signal that physical buyers are getting even more aggressive and the paper-physical disconnect is widening rather than resolving. A widening disconnect favors the bullish scenario where physical eventually takes over pricing. Fifth, stay alert for any news on bank stress, potential government shutdown, or escalating Iran tensions. Any one of these factors could move markets violently in either direction. Banking stress would initially trigger risk-off deleveraging, but ultimately support precious metals as safe havens. Government shutdown concerns could weaken the dollar and support metals. Iran tensions escalating could drive immediate safe haven buying. The market is on edge right now, and any headline that shifts sentiment could be the catalyst that determines whether we go lower or confirm the bottom is in. The New York session decides everything. In just a few hours, we'll know whether this $12 surge from 71 to 83 was a brief technical bounce inside a larger bear move, or whether we just witnessed the moment of maximum fear that marks the beginning of the next major leg higher. The paper market and physical market are giving us completely opposite signals about what should happen next. Paper says the crash continues. Physical says the shortage is real and prices should recover. One of them is right, and one of them is about to be proven wrong. Here's what I want you to understand as we head into this critical session. Whether you are bullish or bearish, prepared or unprepared, the market doesn't care. What matters is that you've done your homework, you understand both scenarios, and you have a plan for either outcome. The people who will thrive through this volatility are not the ones who guessed correctly about direction. They're the ones who prepared for both possibilities and executed their plan with discipline. The queues in Singapore weren't formed by people who knew for certain that 71 was the bottom. They were formed by people who recognized that if it was the bottom, they wanted to be buying, and if it wasn't, they had more capital ready to deploy lower. That's the mindset that survives and profits from extreme volatility. Not certainty, not prediction, preparation. The morning of February 2nd started as the crash of the century. Right now, it might be transforming into one of the greatest buying opportunities of the decade, or it might be a trap before another leg down. The answer is coming, and you're about to find out which story this becomes. The proof is in the premiums, the vaults, the lease rates, and the physical flows. The question is whether paper can maintain control against that physical reality, or whether we're watching the moment when physical demand finally breaks the manipulation and takes over price discovery. Watch what happens when New York opens. Everything you need to know about the next move is about to be revealed.